Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello everybody, my name is Minh and I'm your co-host with Ian from our office here at SMSF Australia. And you listen to the SDA Housing Podcast, our show explains, highlights, guides and brings awareness about all things SDA in this ever-changing and endless world. Good afternoon, Ian. How are you?
I am very good. Min, how are you today?
Awesome. It's been a while since we had you on the podcast.
It's been a while indeed.
Congratulations on your impending baby. Your wife.
2 weeks to go.
Yeah. Good luck there.
Thank you.
Today, the topic, what's our topic? I haven't changed the topic yet. What is our topic? Market trends, buyer trends.
Where are investors going? What's their focus?
Yeah, I think we've seen two really dominant or pretty clear trends the last 6 to 12 months in the SDA world. Ian, what are your thoughts in terms of trends? What are you seeing out there in the marketplace?
I'm noticing that there's more of a focus on higher yields, and there's this need for a property that is built a bit faster and that they can get the property in their hands quicker. And that tends to lend itself towards buying apartments that are either completing or built already. So that there's a few things that people have to overcome in order to be able to make that jump, but less of an interest in the house and land package as we saw over the last few years.
Yeah, I agree. With the land prices, construction costs increasing in the last year or 2 years, it's now pushing the minimum threshold of entry for SDA to be around the 1 million to 1.2 million. Wouldn't you agree?
If you're trying to get into those inner ring areas, those locations with already well-established services and networks, absolutely you're going to have to pay the premium for the land, because obviously the land is more expensive where people want to live. It's when you're looking at those greenfield sites in undeveloped areas, those are the ones that are under the million. But why would you go to an area that's not established and it's going to be posing difficulties finding tenants and people to actually manage the properties?
Ian, do you think that the trend has been lack of stock as well, lack of house and land stock? I'm seeing a lot of fewer available SDA stock in terms of house packages on the market these days than a year ago.
That opens up another tin of trouble. So I'm mixing my metaphors there, but it really is. If you're looking at available stock, you will find that they're in areas where there is now an identified oversupply, and the areas where we really want to be in, we're relying on knockdown and rebuilds or available land in those inner rings, and those are hard to find.
Yes. I mean, we've covered this in the past many times before about good locations, inner ring suburbs, middle inner ring suburbs, stay away from the outer suburbs as well. Near amenities. We've been with this for the last 2 years now. This is a very important topic. I guess the purpose of this podcast today, keeping it nice and sweet and simple here, is to say the two main trends that we are all seeing in our office here of the market of SDA is, number one, investors are sort of turning their back on the SDA house and land product out there because of lack of stock, number one. Number two, the fear of price of entry being too high. And then also, lack of available good stock as well, Ian. I mean, we've always said in the past, be careful about the greenfield areas where there's in the larger states out there further out from metro. There's just too much happening up there. And now we're seeing more proof and evidence of the lending data to show how much volume is going out there in the outer region. So that's a fact, number one. Less stock, less action, less demand for house and land. But more importantly, we're seeing a lot of transactions happening in the apartment market in the middle and inner ring suburbs of the major metro areas. And we're seeing mum and dad investors, super fund buyers, and also one-line buyers who are fund managers and sophisticated investors purchasing the one-liners as a transaction in the apartment market. So the theme has now become apartments, I feel and I see. What are your thoughts, Ian?
I think the apartments answer a solution, that they give a solution to a problem, which is affordability, proximity to the demand and the services, and also they eliminate some of those worries that people have with regard to, is the builder going to be around by the end of the construction, if you're talking about a year to 14 months, like we have in some of the states. If you can eliminate that as a worry, that's much better. If you're buying an apartment and you only need to put down a 10% or a 20% deposit, that again eliminates some of those holding costs and it makes it much more affordable. It opens it up for different lenders and it's a different product. So I would say that it solves a lot of the challenges that have arisen over the last couple of years as the lending environment has become a little bit more restrictive.
The other thing, Ian, is those people who've invested in building 4-bedroom houses, which is care plus 3 citizens, with an apartment, it's just one tenant.
You're not fighting for a second tenant.
With only one.
Yep.
Yeah.
And you're getting a premium because it's a single tenant in an apartment built for that purpose.
So, in the past, people have always said, I want capital growth, I want land. The value of the asset is in the land. I mean, that is the old school way of thinking, Ian. How do you respond to that old school mentality there?
I think the first thing I'm asking is, when you're thinking about capital growth, let's look over the last 20, 30 years. Is there anywhere in Australia that hasn't had that capital growth? And then the answer is obviously going to be yes. And then it comes down to, well, when are you intending on, divesting yourself of this property or selling it on? If you're doing it in the next 2 years, then possibly you will not get a higher value for the property. However, it depends on how it's being looked at as an asset. If you consider this property isn't a residential property in the normal definition, you can look at it as a residential with an income coming from it. So as a going concern, the value to other investors for you when you're trying to sell your property is not just the bricks and mortar, it's the income that's coming in from that property. And that's what's going to inform the future value of that property. So there is a capital growth in it, but it's based on the income, and the income is linked to the CPI every single year. Twice a year, there's an increase in the amount of rent that's given for these SDA properties. So I would argue to the clients, there is that capital growth. It's just not the normal mechanism for it. And with regard to, your play, are you a cash flow play or are you a capital growth play? And the answer generally is I want both. And if you're keeping these properties for the long term, 10, 15 years, maybe even 20, you're going to get that growth in value. And look, you might not be able to realize it until you sell the asset, and you might not be able to release the equity depending on the way that you're purchasing the property, but it will have that cash flow every single year, year after year.
I reckon if you have the capital growth, go buy a house on the beach. They'll guarantee you capital growth.
Absolutely. And it's not SDA.
Yeah. But look, let's be honest. The person who's looking at SDA and talking about and asking about SDA, they know it's a cash flow play. They want cash flow and yield. That's why they're looking at the asset. So if anyone ever comes to me saying, capital growth, well, buddy, it's a yield play. Assume the worst of 0% capital growth, 0, assume that, and your 9, 10, 11% income, that should be fair, right? Because the reality is you will probably end up with about 2 or 3% capital growth and about 9%, 10% yield anyway, which for an investment property, Ian, that 12 to 30% is pretty good, right? 12, 30% every year.
Well, if I said to you, look, you're going to buy a property and it's going to make you a net income after all your costs of $30,000, $40,000 after you've paid for everything. If that income has gone up to $70,000, $80,000, are you going to pay more for that asset in 5 to 10 years' time?
Of course.
Yeah. So the figures will allow you to determine whether this is the right investment for you.
Yeah.
That's the way to think about it.
Yeah. So I think we're going off track here. Again, the topic of this discussion here is the two main trends we're seeing, and that is really people turning their backs on house and land because there's lack of stock or lack of confidence, number one. And number two is there's a very strong evidence of investors and fund managers and one-line buyers and sophisticated investors going into the apartment market because, we've seen the results the last 2 years, Ian, out in the marketplace for STAs in saturation areas. They're all empty or one tenants. I mean, that's a fact. We can't deny it. Right, Ian?
Yeah, there's definitely areas now that we've identified and we've had corroborated by other organisations that they are oversupplied. The western suburbs of Melbourne have been not only identified as oversupplied, but there's also the lender has issued a moratorium on postcodes in that area. And the only way you're going to get lending in those areas is if you change lender. And obviously there are other lenders that are putting their hands up and saying, yes, we would consider those postcodes, but do you really want to go somewhere where we've identified or where it's been identified that there is an oversupply and that's not going to be resolving in anytime soon? So look, the trend is definitely towards that. Does it mean that there are no house and land packages in areas where there's an undersupply? Does that mean that there's no opportunity there? And the answer has to be yes,
there's always opportunity.
You just got to choose the area. Okay?
Yeah, and the right products. Because you know what, Ian, I'm sure 4 or 5 years ago, people thought group home, 5-bedroom, 5-bathroom was the way to go. They thought that. And then it became 4-bedroom, 4-bathroom. And then it became 3-bedroom, 3-bathroom, which is the care opus too. That was a year and a half ago with the ILs. And then there was ILs. Right. And then it was back to HBS.
Yeah.
So evolution of this market it's always changing. And the trends are always changing people's perception of what a good product is. At the end of the day, you as an investor got to choose what you want. I mean, if you love apartments, then you love apartments. If you love houses, you houses. But there's a pro and con of each one. And you live by the sword, you die by the sword. That's just life.
I think the thing to point out to any potential investor is that if you've got somebody that can guide you based on the data and they're leading with the data and that's based on demand and what's going in already, you can avoid the problem areas and you can actually focus on the areas where you're going to get the result that you determine. And the fact that we've had so many changes over the years, it doesn't mean that everybody was wrong. It just means that it's a very human industry and it's changing and adapting around those needs. And there is a bit of a lag. There's a lag in what's coming through the system and what's filtering out in terms of knowledge. And so we, as an organization, our role is to navigate that problem and that changing environment and help our clients make the best decision based on the data as of today.
Exactly. Any advice, any words of advice before we finish up here today, Ian, of how you see the market playing out with this trend of apartments we're seeing that is now picking up, please?
I think, again, the same thing that we need to be aware of with apartments is as long as there is high population areas, well-established networks of carers and all the ancillary services to support those apartments and the number of SDA participants going into those areas, that's the thing we need to be looking out for. If you're building apartments on the outskirts of cities or in greenfield sites, again, you're going to end up with the same kind of problems. But I think obviously we're both aware that the general advice on the number of SDA properties in a development usually is around about that 10% mark. So if they're sticking to that, they're not going to have any issues with regard to the oversupply in a particular area. And whilst we keep connecting with our tenanting agencies, we can actually get ahead of the curve and understand where the demand is coming and what the trends are. So there are problem areas, but we know what they are and we can help our clients avoid them.
Exactly. I think it's been a good year overall, Ian, with regards to how the market has grown. I think now year 5 of SDA across the Eastern Coast. But I look forward to definitely the new year 2025 and beyond of how we see the demand of providers and participants and what kind of quality products they're seeking as well. Because a lot of the areas are saturated and oversupplied or in equilibrium, but there's still opportunity. And where there's the opportunity to do your homework, talk to the right people, get advice, do your numbers, and just be aware of what could go wrong and be ready for have a safety net in those situations. I guess, yeah. As long as you do the right homework and don't rush in, and you'll be fine. I guess that's my advice to anyone listening on this podcast right now. Ian,
I couldn't agree more. Do your due diligence. Do your research beforehand. If you're shopping around and speaking to multiple organizations, look out for those red flags. Make sure that you're not just swallowing any old information that you've been given, and actually delve into the data. And if you're needing to establish that trust with an organization, see if you can meet them face to face. There's nothing better than knowing that you've got somebody to prepare to speak to you directly and guide you in that process, because it's a long process and you want to know that the organization is going to be around to see the results come to fruition.
Yeah. In the meantime, if you have any questions or concerns or would like to talk to myself or Ian, please give us a call on our office number 1300 254 396 or email us on info@nds.property, and we'll happily take any your calls or inquiries and provide some insight to how we can help you moving forwards with any SDA there. Thank you very much for listening. Goodbye, Ian.
Goodbye, Min.
Bye-bye.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.